They said $100 was the ceiling. They were wrong. Because at $103, silver isn't behaving like a commodity anymore. It's behaving like a currency. And if you're watching this on January 24th, 2026, you're not watching a rally. You're watching a measuring stick snap in half. Spot silver is printing 103.18. That's up 44% in 24 days from 71.59 on January 1st and up more than 225% over the last 12 months. Gold is sitting near $4,979. The gold to silver ratio has collapsed into the 48 to 50 range, and the CME just hit the silver contract with a maintenance margin number that screams one thing: get small players out. $32,500, a 47% jump. That's not a risk update, that's a kill switch. So today's video is not should you buy. Today's video is why silver at 103s is the official end of the US dollar era. And I know that sounds dramatic, so let's do this the only way that matters, with the math, with the plumbing, and with the part nobody wants to say out loud. Silver. At 103, the official end of the US dollar era. Listen, when people say end of the dollar, most viewers imagine one of two fantasies. Fantasy 1. Tomorrow morning, the grocery store rejects dollars and wants gold bars. Fantasy 2, the dollar goes to zero in a single day. That's not how empires decay. That's not how money dies. A reserve currency doesn't explode. It leaks. It loses the power to measure reality. And then one day, you look up and realize the world stopped using your ruler. Not because they hate you, because your ruler lies. So when I say end of the US dollar era, I'm not talking about a headline. I'm talking about a transfer of price discovery, a transfer of trust, a transfer of settlement power, and silver is the loudest, smallest, most violent proof of that transfer happening in real time. The snapshot, what 103 really means. Here's the quick market snapshot so you have the whole battlefield in your head. Spot silver, 103.18, month to date, plus 44% since Jan 12-month move, plus 25% plus, gold, roughly 4,179, gold, silver ratio, 148.2.1, annual silver deficit estimate, 240 million ounces, CME maintenance margin, $32,500, kill switch territory. Now, if all you do is stare at a screen, you'll miss the real story, because in 2026 there are two silver prices. The screen price, spot, futures, paper contracts. The hands price, what it costs to actually get metal in your hand, in your vault, in your factory. And those two prices are drifting apart. That drift is the crack in the system. The gap, when one metal has two realities. Let me paint it. You open your app. It says $103. You walk into a dealer, you try to buy size, and suddenly you're negotiating. Premiums spike, inventory is limited, delivery times stretch. And then you hear the part that sounds like conspiracy until it keeps happening. In major hubs, converted physical prices in the East are already trading at a lead. In other words, the real price discovery is happening where the metal is flowing, east. This is what happens right before a market admits the truth. The paper market keeps quoting a price for a product it can't reliably deliver, and the physical market starts charging a different price for the thing that actually exists. That's not theory, that's basic supply, demand, and trust. If you can't get the metal, the screen price becomes a suggestion, a reference, a story. And when your currency is the unit of account for that story, your currency is the thing being questioned. Because the world is looking at dollars and saying, okay, but what do they buy right now in the real world? That is the reserve currency test. And silver just walked into the exam room with a megaphone. The industrial math, why this is not a luxury rally. Now let's do the uncomfortable part, the industrial math. The old story was simple. Gold is money. Silver is poor man's gold. That story is dead, because silver is becoming strategic industrial fuel. And fuel markets don't behave like collectibles. They behave like bottlenecks. They behave like rationing. They behave like war. Here's the driver most people still don't understand: solar. In 2026, global solar capacity is pushing around 665 gigawatts. That requires roughly 120 to 125 million ounces of silver for panels alone. Not maybe. Not if investors feel bullish. If the panels get built, the metal gets consumed, and silver is not a use it and store it metal. Silver is a use it and it's gone metal. Some is recycled, sure, after cost, after time, after collection, but in the moment, it's consumption. Now stack on the rest. AI data centers, massive power buildouts, grid upgrades, EVs and charging infrastructure, electronics, medical, defense. Silver is in the arteries of the modern world, which means the market is forced to reprice it from shine to necessity. And necessities don't care about your bond yields. Necessities care about inventory. The deficit, 6 years in a row. Now here's where the math turns into a chokehold. 2026 marks the 6th consecutive year of a global silver deficit. Not a one-year hiccup, a structural shortage. The world is using more silver than it produces, year after year. And deficits don't solve themselves with hope. They solve with one of two things: demand destruction, price. So the question is, can we make more silver at 103? No. Because here's the part that makes silver different from oil, different from copper, different from most commodities people understand. Silver supply is inelastic. Roughly 70% of silver production is a byproduct of mining other metals: copper, zinc, lead. Meaning, even if silver triples, you can't just flip a switch and turn on a silver mine. A miner doesn't wake up and say, let's produce more silver. They produce more silver when they produce more copper. So silver can go vertical while supply barely moves. That is the definition of a squeeze. And the world is squeezing itself because the demand is strategic and the supply is chained to other markets. Section 5, the smoking gun, the gold to silver ratio collapse. Now let's talk about the ratio, because the ratio tells you what class of asset silver is becoming. For most of 2025, the gold to silver ratio hovered near 80.1. That's the normal modern distortion. Gold is big, liquid, central bank supported. Silver is smaller, more volatile, treated as secondary. But today, the ratio is compressing into 48.1, 50.1. That is not a casual move. A falling ratio while gold is screaming higher is a signal you need to respect. It usually means one of two things. Either silver demand is exploding or silver supply is failing. And in a small market like silver, those two often happen at the same time. Here's why it matters. Gold is a battleship. Silver is a speedboat. When institutional capital rotates, the speedboat tips. If the ratio returned to a historical sound money average, let's say 15:1, then with gold near $4,900, silver would need to be priced north of $330 an ounce. Now, I'm not saying you wake up tomorrow at $330. I'm saying that's what the ratio is whispering about the direction of stress. The ratio is the market's lie detector, and right now it is calling the old narrative a liar. The exchange crisis, when price is not the product. Now we get to the plumbing. COMEX, LBMA, the paper system. This is where the end of the dollar era becomes more than a speech. It becomes mechanics. Because the paper system is built on a promise. Contracts can be settled with metal. Not always. Not for everyone. But in principle, the system must appear capable of delivery. If confidence in delivery breaks, the contract stops being money-like. It becomes a bet. And when a money-like contract becomes a bet, you get a premium for reality. You get two prices. You get rationing. You get forced cash settlement whispers. You get stress. Now look at the behavior. The CME raises margins. Maintenance margin goes to $32,500. People call it a volatility response. But in market history, margin hikes in the middle of a parabolic move do one thing best. They force liquidations. They flush leveraged longs. They protect the system by ejecting the weak hands. And here's the part nobody likes. When margin hikes arrive during a squeeze, they are also a signal that someone is trapped. Because if the market was calm, you wouldn't need a kill switch. You would need a seatbelt. A kill switch implies the car is about to hit a wall. Now add the other side. Inventory drain. London and New York inventories sitting at multi-decade lows. The vaults are not infinite, and the system is built on leverage. Paper claims are multiples of the metal. So 103s become symbolic. It becomes the number that says, we have entered the phase where the system must choose who gets metal and who gets a refund. And a refund is not the product. Why this is actually about the dollar. Okay, now connect the dots. Why does a silver squeeze say, end of the dollar era? Because the dollar's superpower has never been the green paper. The superpower is pricing. The dollar is the unit the world uses to price oil, price debt, price risk, price commodities, price survival. It's the language of settlement, and that power is maintained by trust. Trust that dollars can be turned into real things without friction. But when strategic goods start repricing faster than the currency, that trust erodes. When physical premiums blow out and price discovery moves away from US-centered paper markets, that trust erodes. When the market must raise margins to stop a contract from cascading, that trust erodes. Because the world doesn't just watch the price. The world watches the system behind the price. And the system behind the price is saying, physical is scarce, paper is abundant, dollars buy paper easily, dollars buy physical with difficulty. That's the shift. That's the regime change, not a Hollywood collapse. A slow, brutal reassessment of what a dollar can actually command. A story, the three buyers. Let me tell you a story with three buyers. Buyer one is a retail investor. He sees $103 on the screen. He thinks, if it hit 103, it can hit $130. He opens a margin account. He buys leverage. He feels smart right before a margin call because he is playing the paper game where the rules can change overnight. Buyer two is a refiner. He doesn't care about your chart. He cares about contracts. He cares about delivery. He cares about feedstock. At 103, he does not say, wow, expensive. He says, can I get it? When? How much? What's the premium? Buyer three is a solar procurement officer. Her KPI is not investment returns. Her KPI is, did the panels arrive? At 103, she does not say, silver is overbought. She says, lock supply, secure inventory, pay what you must. Now ask yourself, which buyer sets the real price? In the old world, buyer one had influence. In the new world, buyers two and three dominate. Because strategic demand doesn't blink. It doesn't sell because of RSI. It buys because factories don't run on opinions. Why the East matters. Now, the controversial part, the East. When you hear that physical pricing in hubs like Shanghai is leading, that matters for a simple reason. The highest bidder for physical silver becomes the price setter. And if the highest bidder is not settling in your market becomes a derivative of theirs. That's what end of era looks like. Price discovery migrates, liquidity migrates, and then eventually settlement power migrates. Empires don't collapse on television. They watch the auctions move to a different room. The dollar era is ending when, let's be precise, the US dollar era is ending when the world stops treating dollars as the safest claim on real goods. The world starts treating dollars as a convenient interface, not a store of value. Strategic commodities are repriced upward faster than the currency can credibly stabilize. Physical markets develop persistent premiums over paper benchmarks. The paper promise requires increasing interventions to appear stable. Silver at 103 is one of those loud signals. Not because silver is magic, because silver is small. And small markets break first. They are the canary in the monetary coal mine. Gold moves like a glacier. Silver moves like a scream. The debt math. Why 103? Silver and the dollar are the same story. Now you might be thinking, okay, silver is tight, solar is booming, fine. But why are you calling it the end of the dollar era? Because the dollar era was built on one giant assumption, that the United States could issue endless claims, debt, dollars, promises, and the world would keep accepting those claims as the cleanest, safest collateral on earth. For decades, that assumption was rewarded. If you held dollars, you held access. If you held treasuries, you held power. If you priced everything in USD, you controlled the scoreboard. But here's the problem with a system that runs on claims. Eventually, the claims grow faster than the real stuff. Debt grows faster than energy. Money supply grows faster than mined output. Paper expands faster than atoms. And when that gap becomes obvious, hard assets don't rally. They reprice to expose the gap. So silver at 103 is not just silver up. It's the market saying, your claims are multiplying, my supply is not. That's the entire story. Why this move feels different. The new buyers are not traders. In the old cycle, silver spikes were mostly financial. Hot money in, hot money out, charts, momentum, then a crash when the trade got crowded. But look at what's powering this move in 2026. Industrial procurement, national stockpiling, supply chain security. Just-in-case inventory replacing just-in-time. Companies and governments acting like shortages are normal. That is a different buyer. A trader sells when he's scared. A factory buys when it's scared. That's why this feels like a regime change. The fear is on the demand side, and that's why the move is so violent. The atoms versus bytes era, why real things are winning. We lived through an era where the world fell in love with paper and pixels, digital assets, financial engineering, derivatives stacked on derivatives, leverage on leverage, promises on promises. And for a while, it worked, because the supply of paper and pixels is infinite. But the physical world never changed. A solar panel still needs real inputs. A grid still needs metal. A car still needs conductors. A data center still needs electricity and hardware. So here's the uncomfortable thesis. The next decade is going to be a war between infinite claims and finite atoms. And in that war, the finite things get repriced first. Silver is one of those finite things. The exchange. Kill switch, explained like you're in the room. Let's simplify the margin move. Imagine you're in a crowded theater. Everyone owns a ticket, but the theater doesn't have enough seats. As long as nobody checks, the show goes on. But the moment the crowd surges, everyone tries to sit at once, something has to happen. The exchange has two options. Option A, admit the seat shortage. Option B, make it expensive to rush the seats. That's what a margin hike is. It doesn't create silver. It makes participation harder. It turns the rush into a financial penalty. So when you see a 47% margin hike, don't just hear volatility. Here, we need fewer people demanding delivery. And if you're a small player using leverage, you are the easiest person to remove. You don't get a heroic story. You get liquidated. Not because you were wrong on the trend, because you were wrong on the instrument. The GSR warning. Why 48.1 is a siren, not a trophy. Let's go back to the ratio for a second, because people misunderstand what compression actually means. When the ratio collapses, it's not just silver outperforms. It's the market revealing stress in the smaller metal. Silver's market is tiny compared to gold. So when large money decides silver is strategic, there isn't enough liquidity to absorb it smoothly. The price jumps, the ratio compresses, and the compression itself becomes a signal to more capital. Something is happening here. That is reflexivity. And reflexivity is how you get parabolic moves. So don't celebrate 48.1 like it's a finish line. Treat it like a siren. It's telling you the market is transitioning from calm pricing to emergency pricing. The official end moment, what changes after 100. So why do I call $103 official? Because $100 was the psychological border between two worlds. Below $100, most people can still pretend this is just a trade. Above $100, the conversation changes. Boards ask questions, governments notice, producers renegotiate, manufacturers build contingencies, banks adjust collateral assumptions, retail gets emotional, and once the entire ecosystem starts behaving differently, the old price framework doesn't come back easily. That's why $103 matters. It is the moment the system is forced to admit that silver is not cheap jewelry metal anymore. It's a strategic constraint. What to watch now? The 4 pressure gauges. If you want to track whether this is a spike or a shift, stop watching one number. Watch 4 pressure gauges, physical premiums. If the screen price rises but premiums fall, that's financial heat. If premiums rise with price, that's physical stress. Inventories, not headlines. Inventory trends. If vault inventories keep bleeding while price rises, the market is not satisfied. Term structure. If near-term contracts trade with urgency, if people pay more for metal now than later, that's not normal commodity behavior. That's scarcity behavior, the ratio. If gold stays elevated and the ratio keeps compressing, silver is acting like a monetary metal again. Except this time, it's also an industrial metal. That combination is rare and dangerous. A realistic take. This doesn't end tomorrow, it ends by habit. Let me ground this. The dollar doesn't die because of one price chart. The dollar loses its era when habits change. When corporations settle more trade outside USD, when reserves diversify, when commodities price in multiple benchmarks, when holding dollars feels like holding melting ice. Those changes don't happen in a day. They happen in waves. And silver is one of the earliest waves because it is both money-like and supply-like. It sits at the intersection of trust and scarcity. That's why it screams first. The most important warning, don't let a true thesis turn into a bad decision. I'll say it again because I care about your survival more than your excitement. A true thesis can still destroy you if you express it the wrong way. Silver can be the right long-term story and still shake you out violently because in a squeeze market, the price can move like a weapon. Up, to lure, down, to liquidate, up, to punish the short, down, to punish the long. So if you're here for the long game, respect the short game. Respect position sizing. Respect volatility. Respect the fact that the exchange can change the rules faster than you can change your mind. That's why I keep repeating this phrase. Don't confuse being right with staying solvent. Let me end with a visual. Imagine the world is building a bridge. Solar, AI, electrification, reshoring, defense. The bridge needs steel, copper, and silver bolts. Now imagine the architect measures every bolt with a ruler that stretches and shrinks every week. That ruler is your currency. At some point, the builders stop trusting the ruler. They switch rulers, or they price the bolts in bolts. That's the end of an era. Not because the old ruler disappears, because it stops being believed. Silver at $103 is the moment millions of people realized the ruler is bending, and once you see that, you can't unsee it. What happens next? 3 paths. So where does this go? There are 3 paths, and none of them are comfortable. Path 1, demand destruction. That means recession, slowdowns, projects delayed, consumption cut. But here's the catch. A lot of silver demand is tied to national strategy and energy transition. Governments don't demand destroy easily. They subsidize, they prioritize, they ration. Path 2. Higher prices. The market simply reprices to a level where supply and demand can meet through substitution, thrifting, recycling, and efficiency. But substitution for silver isn't easy. In many uses, silver is used because it's the best conductor, the most reliable, the safest. Replacing it means performance loss, failure risk. That's expensive. Path 3. A paper event. That's the one nobody wants to say. A moment where the paper system is forced to settle stress by changing terms, cash settlement incentives, delivery delays, rule changes, position limits, margin escalations, market emergency language. If you've studied any commodity squeeze in history, you know this pattern. And at 103s, the pattern is no longer theoretical. What you should and should not do. Now let me be crystal clear. I'm not telling you to mortgage your life. I'm not telling you to chase candles. I'm not telling you to worship a number. Here's what I am telling you. Stop confusing the paper price with the physical reality. If you're going to participate, understand the instrument you're holding. Futures are not a silver coin. ETFs are not a bar. Options are not metal. They are claims, structured through the same plumbing that is currently under stress. If you're using leverage in a market where margin can jump 47% overnight, you're not investing. You're volunteering as liquidity. So the rules are simple. Don't get forced out by a broker. Don't let a margin desk decide your fate. Have a plan that survives volatility. And if you're a long-term holder, the question isn't, is $103 high? The question is, what is silver becoming? Because if silver is being repriced as strategic fuel, then today's price is not about greed. It's about scarcity meeting necessity. The final point, this is about trust. Let's end with the real truth. The dollar era ends when trust shifts. And trust shifts when reality diverges from the story. The story was, paper markets are efficient, liquid, and deliverable. Reality is, physical premiums are rising, inventories are tight, and the exchange is flipping switches. The story was, silver is a sidekick. Reality is, silver is an industrial artery. The story was, the dollar measures everything. Reality is, the things that matter most are being repriced faster than the dollar can keep up. So yes, silver at 103 is a milestone, but not because it's a win, because it's a warning that the world is reordering what it values, a warning that we have entered the era where commodities stop behaving like trades and start behaving like votes. Votes against paper promises, votes for physical certainty, votes for the things you can build with. If you want a simple test for, is this a dollar story or just a silver story, ask this. Can the world get the things it needs, energy, chips, infrastructure, metals, without paying a growing penalty to stay inside the dollar system? If the penalty keeps rising, dollars still circulate, but they stop commanding respect. That's how a reserve currency fades. Not rejected, just avoided when it matters most. And that's why silver is the alarm bell. It's small enough to break first, essential enough to force demand, and visible enough to expose the gap between promises and inventory, on camera, in public, in real time. So here's my question to you. Do you think 103 is the top, or do you think it's the launch pad? And if the ratio keeps compressing, if physical premiums keep widening, if inventories keep draining, what number do you think finally forces the system to admit the truth? Drop your answer in the comments. And if you want the next update the moment it happens, subscribe. Because in this market, the headlines lag, the metal moves first.